Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
Dan Rasmussen is the founder of CIO of Verdad Advisers and author of an excellent weekly blog and a new book, The Humble Investor. I've enjoyed his blog for a long time, not just because we're both skeptical of private equity and its ability to continue to deliver anything near historical returns. We're also both wary of private credit, but it stands arguments which I find interesting because they're almost invariably thought-provoking. Our discussion in the podcast touches on private equity, but we mainly cover topics where we are less in agreement. For example, the importance of profit forecasts, where Dan's research suggests they're a bit of a waste of time. But I know that a good analyst can generate significant returns by getting long-term forecasts more accurate than the market. We also disagree on forecast horizons. Dan thinks you've got the best chance of getting the next quarter right because it's closest in. But my experience is that quarterly forecasting can be much more variable, and you can have much greater confidence looking 18 months out in many cases. Dan thinks growth isn't that persistent. I argue there are lots of great companies like Coca-Cola where growth has been highly persistent over decades. It isn't so much that we disagree on these subjects. It's more that we view these factors through different lenses. We discussed Dan's favourite metric, gross profit to total assets, why it's important and why it's persistent. I really enjoyed talking to Dan, and I'm sure you too will enjoy our conversation. So Dan, welcome to the podcast. I've been reading your blogs and Substack for quite a long time and really enjoying it. So I'm delighted you've come on. And you started in private equity after graduating from Harvard and doing an MBA at Stanford. I'm guessing you didn't always want to be an investor.
You know, I didn't, Stephen. I studied history and literature as an undergrad, and I actually wrote a book that was my senior thesis about a slave revolt in New Orleans. So I think if you'd asked me in college, I would have said, maybe I want to be a historian or a writer. But when I was graduating from college, I talked to a bunch of people, and all my favorite professors said, absolutely don't become a professor. It's the worst career ever. Don't do it. And then I talked to my dad, who's a lawyer, and he said, Dan, I was the top of my class at law school. All the people at the bottom of my class went into business. They weren't as smart as me, but they made 3 to 5 times as much money, retired 10 years ago, and didn't work as hard. So don't become a lawyer, go into business. It seems like it could be relatively easy. And so I was sort of inclined to try business, and I went and applied to a bunch of random jobs, and I ended up getting a job at Bridgewater. And I was very lucky that I did, because Bridgewater's approach at that point was very much focused on studying history to derive the lessons that you could take from history and then apply it to trading different securities in the present. And so I sort of thought, well, gee, maybe investing is a place where I can take my interest in studying history and indeed philosophy and a variety of other things and apply it to trying to make money, which obviously would be preferable to not making money. And so I think that's really what got me interested in the field. And that's really been true. It's really the way I've built my investing style, and what I've focused my research time on is saying, the future is really wildly unpredictable. It's really hard to know what's going to happen in the future, but can we study the past to derive lessons about the way we should behave? And I think that's been, one of the kind of guiding questions that has motivated my research and writing in the years since.
So the book I mean, I was quite surprised because when I looked up your current book, which we're going to talk about, The Humble Investor, which I'm sure, I mean, it's a great book. I'm sure it'll be a huge success. But you were already a New York Times bestselling author with your first book, American Uprising, The Untold Story of America's Largest Slave Revolt. So, I mean, what made you write that? You were still at university when you wrote that. And you became a New York Times bestselling author.
Yeah, so it was my senior thesis. I was just, I I I when I went into college, my older brother actually gave me advice. He said, in college, no one respects a generalist, so pick some very narrow niche and focus on it. And so I was very interested in history. I got very interested in sort of the 19th century American South, the history of slavery and American expansion. And probably my sophomore junior year, I came upon this slave revolt, which was I was taking mostly independent studies at that point, and I got very interested in it. And so I spent, 2 years, 3 years, researching it and writing this book. And so perhaps the only analog from that to investing is that I've remained very interested in this idea, obviously, of studying niches, staying in narrow areas where I can feel like I can get a lot of expertise. Rather than sort of entering it'd be very tough to write a best-selling book about the Civil War as a 21-year-old, but to write one about a obscure slave revolt, much easier. It was an unusual topic.
Well, you
Nobody had written
say
about it.
much easier, but to get on the New York Times best-selling, I mean, that's a pretty amazing achievement. If you were doing that now, I
Yeah.
mean, to do it when you were a university student, is that what made Bridgewater hire you?
No, this, and in fact, this didn't come out until I was already working at Bain Capital, and I didn't tell anyone at Bain Capital about it because until it came out, because I didn't want them to think that I was slacking off and not doing my job. So I would just do it on sort of nights and weekends, finishing up the book and editing it and stuff, and then yeah, so it was a surprise to everyone.
And what made you write The Humble Investor? I mean, what prompted you? Obviously, you had the best-selling author title already, so you had that in the bag. But what made you want to write a book, another book?
Yeah, well, so from the beginning, when I started my firm, Verdad, I started writing a weekly research blog, and I'd mail it out to everybody, first to my investors, and then the group became broader. And it was all my thoughts about investing, all the research I was doing. We do a ton of research here. I sort of think of my firm as a think tank that manages money. We're constantly studying different things, and then we translate that research into actionable, investment strategies or decisions in real time. And after last year was our 10-year anniversary as a firm, and I got to thinking, maybe this would be a good time to step back and say, well, what does all this mean? I've been writing these weekly pieces that sort of might comment on something that's going on in the market that week, or it might comment on, a piece of research that we've done on some esoteric topic. But what is the underlying thesis, or what is it that ties them all together, and can I put the best of our research together in a really punchy book that would convey sort of our core ideas to a new set of readers, hopefully.
Well, it's a really excellent book. I mean, I've enjoyed your writing, as I said. I've enjoyed the weekly, but the book's divided into three parts. So the first section's on how bad we are at forecasting. Um, Part two, you critique conventional investment theory. And part three, you look at market timing, bubbles, and crises. So part one is about forecasting. And you show how bad we are at it. Do you want to start with telling the story? Because I think it's a good scene setter of how the rats beat the Yale students.
Yeah, this is a wonderful old experiment, and they basically they have a food feeders, and the I'm gonna get it approximately right because I'm not reading from the book, but the feed comes out of the one side about 60% of the time, and the out of the other 40% of the time, but it's random which side it comes out. Other than that, it's weighted to one rather than the other. And it turns out that pretty quickly the rats figure out that more comes out of one than the other. And so they just sit there at the one that 60% of the time the food comes out of, and they just don't move. So it's an effective strategy. They figure out how to win. The Yale students, however, try to discern patterns. They think that in the randomness, so they think, well, this must be some sort of math puzzle, and so if it comes out here and then here and then here, maybe it comes out twice here and then twice there, and so they end up being much worse than the rats. Their expertise, or their faith in their own expertise, their intelligence is what damns them relative to the simple strategy of pursuing base rates.
Yeah, it's a very funny illustration. The book's full of good illustrations. But I was really interested because you think that forecasting is fundamentally a waste of time. And so my question to you is, without I do disbelieve you, and I'll argue with you in a minute. But why is it that you think you're right when every equity analyst in the world is busy looking at earnings forecasts and occasionally the cash flow?
Yeah, this is a great question. So I'll start by saying let's take out an extreme position, which I'll call future nihilism, which is the idea that nobody can predict anything about the future, and I'm not quite there, and I don't think that's the right answer. But let's start from there, and because I think that's the bar we have to jump over. We have to prove that we're better than complete nihilism, and future nihilism would essentially assume random chance. That, for example, a company's earnings growth is completely unpredictable. So perhaps the best predictor of future earnings is today's earnings, maybe plus or minus GDP growth. And it turns out that for earnings forecasts, that's actually a really hard bar to hit. That when you look at actually statistically how all these analysts do in predicting earnings, they really don't beat a simple bar like take the mean and grow it at GDP. That tends to be probably 20 or 30% more accurate than analyst forecasts. And the reason it's more accurate than analyst forecasts is related to the methodology that most analysts use. Most analysts, when they try to predict the future growth of a company, look at the past earnings growth, right? So they say, okay, well, this company grew revenue 5% last year and 7% this year, and 9% the year before, and therefore I'm going to put it as somewhere between a 5 to 9% grower, and so that's what I'm going to extrapolate into the future. So they're starting by extrapolating the historical financials. And what we did is we looked at an old paper, a beautiful paper called The Persistence and Predictability of Growth, and updated it with the latest 20 years of data. And what we showed is that past growth, either of revenue or earnings or cash flows, does not predict future revenues, earnings, or cash flow growth. So the top quartile, for example, has no more probability of being in the top quartile of future growth than the bottom quartile. And you can look at it even another way, which isn't in the book, but was one of our recent research pieces, where Japanese companies are required to issue 1 year forward guidance on revenues and net income. And they've been required to do this for 20 years. So you have a complete data set of how every public company in Japan thought they were going to grow earnings at every given point, and then what ended up happening. And what we did is if you divide that into three groups, your lowest growth, your middle tier of growth, and your highest tier of growth, you find that Japanese companies are about 50% accurate at sorting themselves into those three categories, which is kind of great, right? So random chance would be 30%. They're at 50%. So they're more accurate than random chance, almost twice as good at random chance. But 50% of the time, they're still way out, way wrong, right? They thought they were going to be a fast grower and they were a medium grower. They thought they were going to be a slow grower and they were a fast grower, right? So the future, the unpredictability of the future is sort of an impossible. And remember, this is just 1 year forward. So this is like in April predicting revenues through next March, right? So even on this very short horizon, they're wrong sort of directionally 50% of the time, 50% on they're right, which is better than random chance. But what then becomes even more problematic is what happens when they're wrong. So it turns out that if you are high growth and you predict high growth and you achieve high growth, your stock does fine, a little better than the market. But if you predict high growth and you don't achieve it, the market punishes you quite badly. And so in aggregate, betting on the high growth firms ends up being slightly worse than the average. On the other hand, if you look at the low growth predictions, if you predict low growth and you achieve low growth, the stock market, you're fine. You do a little worse than the average, but you're basically fine. But on the other hand, if you predict low growth and then you achieve high growth, your stock goes way up. And so on average, the stuff that predicts low growth actually does slightly better. And I think it's in this essence, this sort of arbitrage in the way of looking at the world is to say, well, gee, if the biggest arbitrage is that other people think they can predict the future, but 50% of the time plus they're wrong, what opportunities does that open up to me as an investor? What should I do in response to that data? Well, first I need to be humble about my own abilities, right? So first thing, let me stop doing that, right? Because if I know that I'm going to be just like those Japanese companies, it might be the experts on them, it might be a short-term forecast, but 50% of the time they're wrong. Probably 50% of the time I'm going to be wrong. And if the punishment for being wrong is this great, well, gee, it makes doing it not even worthwhile. And what I want to do, therefore, is to say, well, if this worldview is right, if in fact predicting the future is so much more difficult than people think it is, and people are making these sort of systematic errors in terms of doing this and betting on it, how can I arbitrage that? What should I do? And that's really the sort of provocation that the book poses in the first few chapters.
I mean, it's quite a radical idea. I mean, I don't disbelieve your research, but I'm just curious as to why nobody else has done this.
I think that in some sense, it's because I do a lot of deep quantitative research, but I began as a fundamental investor and I ask relatively basic questions, whereas I think a lot of academics, they've never actually worked in fund management. So they don't realize the percentage of time that's spent by your average analyst building these LBO models or DCF models, right? So it just doesn't occur to them to think, oh, really, that's all they think they have this sort of abstractions like, oh, they're making markets efficient by reacting to historical data or reacting to news, but they don't understand that the reaction function is channeled through a model. And once you realize that the model is driving these decisions, that people are spending all this time updating these models, this is a core activity of people on Wall Street, then you have to start asking, well, how accurate are the models? And you find that the Wall Street firms themselves don't spend a lot of time on that. If they would have stopped doing the models years ago.
Oh, so I mean, it's not surprising that the sell side don't spend time on. Well, they might spend time checking how well they do for internal consumption, but I mean, I can perfectly understand why they wouldn't want that to be externally consumed, because it wouldn't show them in a very good light. But there's, the idea of the equity analysis become much more professional in recent years, and it would surprise me that if some of the big firms don't look at this very carefully. And is it possible? I mean, because I would argue that I'm very good at forecasting company profitability. So now that's not to say that I'm very good over a large universe, but I'm very good at finding things that I can forecast better than the stock market. So I think that definitely you can do. I believe you can do this, and it would be very surprising to me if firms like BlackRock and Fidelity and so forth, these multi-trillion-dollar firms that are employing hundreds of analysts and producing thousands of models every year, it would be very surprising if they weren't testing how accurate they were.
I think that anyone that's tested it has found basically what I've found, which is this huge degree of unpredictability. And if they test it correctly, they'll generally find that the forecasts are worse than using just a mean forecast. It's really hard to beat a mean that grows at GDP. The variance in forecast is too big and the error rate is too high. And I think that Stephen, one of the things I've reflected on is, and there's this fundamental tension you'll hear these days, people talking about the pod shops, and they'll say, gee, the pod shops are so focused on next quarter's earnings. Why are they so focused on next quarter's earnings? And my take is that predictability sort of has to be better in the short term than the long term, right? Like it's got to be easier to predict tomorrow than it is next week, and it's easier to predict next week than next month, and it's easier to predict next month than next year, right? It's just got kind of sort of has to be that way. And so I think that maybe the reason all the pod shops are so focused on next quarter's earnings is that it's the only place they can really get an edge, because the longer term forecast becomes so much more difficult to do. You just have more future uncertainty compounding, and more potential room for error. And I also think,
Right, I completely disagree with that, because, and I've done this and I've spent a lot of time thinking about it, a lot of time doing it, because when I was on the sell side, I used to get phoned up every quarter by what are now the pod shops, so the predecessors, forerunners of the pod shops, and I'll spare them the embarrassment by naming them, but their principal is one of the richest men in Wall Street. And these guys would phone me up and they'd say, "Oh, Steve, we'd like to know your forecast for the next quarter for an airline." And I would say, we had this conversation 3 months ago. I don't really know why you're calling me, because I told you that my probability of forecasting this airline's quarterly profit next quarter is very, 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 very limited, because there's so many, there's so many variables. Where I have an idea that, I've had some external confirming evidence that something's happened that isn't in the analyst model. So I think that there's going to be, they're going to either beat or miss significantly. Then I'll give you a call so you can save your phone bill, and your time. And of course, we did this. We had the same joke every quarter. But I think that there's a huge, particularly with a stock like a company like an airline, where there's a huge number of random elements. But what I think is perfectly possible is that if you look at 18 months, you can find a number of companies where the stock market and analysts have failed to recognize some change in the external environment, which dictates that the probabilities are very heavily skewed either to a beat or a miss 18 months out. So this is just to say that there's more randomness, I think, in the short term, and more ability to apply skill looking at a 12-month picture, an 18-month picture, a 24-month picture. Do you disagree with me? I mean,
yeah. I mean, I think that we can. I think I always have to be careful in what I'm saying to differentiate between. I don't think it's impossible that skill exists. So I'm not one of those extremists that says there aren't people that are really skilled. I think there are people that are really skilled, but what I'm concerned with is the average, or the sort of market cap weighted reality. And I think that I can't tell you about you, and I can't tell you about Citadel, or I can't tell you about people that are super high achievers, but I can tell you about on average. And I can tell you that on average, when you start studying this, the ability to predict the future declines over time. The further out that you go, the more unpredictable the future becomes. And I think that perhaps the reason that people don't like to acknowledge this is they say, well, when I try to do short-term forecasts, I'm wrong so much of the time. I must be better at the long-term forecasts. And I think that's just selective memory a lot of the time, that people, when you think about short-term forecasts, you think about all the mistakes that you make, because of course you make mistakes. And then with the long-term ones, 2 years later, you've sort of forgotten that you made that forecast, or you've adjusted it some way. And so I think that the reason that a lot of firms, don't go through and systematically build a database of past predictions is sort of, so why would I do that? Why would I take predictions from 5 years ago? What use is that to my business today? It's an introspective journey, but it's tremendously revealing of how difficult the problem is.
Well, I hope you're enjoying this episode, and if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing-related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, we also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information. I mean, I don't know Citadel particularly well, and it wasn't who I was referring to. But, let's take a generic pod shop. I mean, I would be amazed if they weren't measuring exactly what their analysts were forecasting and working out what they were good at and what they were bad at in order that they could improve their accuracy.
And I think they are, and I think it's almost entirely focused on next quarter.
That's fair enough. I mean, you think the capital asset pricing model is a waste of time, which I completely agree with you. I've never, I mean, I understand it's a useful construct to, to understand, a theory and think about how you might value a business, but it's of no practical use whatsoever.
It's of no practical use, and it's such a waste of time that it's forced upon finance students worldwide to construct these silly things. I think a big part of the problem, right? We've talked about the unpredictability of future growth. Risk is equally unpredictable. If you, I don't think if you can't predict future, you can't predict the numerator and you can't predict the denominator. You can't predict the X and you can't predict the Y. How are you supposed to know how volatile a stock is going to be multiple years in the future, or how risky it is? I mean, I think there's this sort of intuition, right, that risk and return should be related. And where I think the mathematicians have gone wrong is not allowing for the possibility of errors. And not allowing for the possibility of imprecise predictions, right? That there sort of has to be a model where risk and return are linearly related. But what if we just don't know either variable and the future is kind of chaotic and random, and we're trying to separate some signal from the noise? And it's not going to explain, the CAPM just doesn't explain, particularly for equities. Higher volatility equities do not have higher returns than lower volatility equities on average. Where CAPM can be more useful is sort of as a broad intuition around asset classes, right? Okay, stocks are more volatile than bonds and they have higher returns than bonds, but it's not always true. Oil is a heck of a lot more volatile than stocks, but oil doesn't offer higher returns, right? Just the fact that something is volatile tells you something about its volatility, but it doesn't necessarily tell you something about its returns. And I think that's where CAPM fails.
No, I thought the Warren Buffett comment that the stock that's halved has seen its volatility go up, but it's a hell of a lot less risky. And just that very simple example should tell you that no university academic worth his salt would be dream of teaching the capital asset pricing model in his class. But I don't think any of them have been discouraged in spite of the great man's clear pronouncement. So listen, part 2 of your book, The Humble Investor. Why did you choose the title The Humble Investor?
Because I was very focused on this idea about being humble about our ability to predict the future. That's sort of the core message, right? That to take away, which is to first, take the mote out of your own eye, as it were, and to say, well, gee, if I start from the premise, start from my future nihilism premise, let's start from the premise the future is entirely unpredictable, that anything that I do to predict the future isn't going to work, then what should I do? Right? What follows from that? And that's sort of the thought exercise that I'm trying to provoke.
No, it's so interesting. Part 2 starts with how do you find an edge? And you highlight that historically cheap stocks do better than dear stocks, and small caps beat large caps. Now, this hasn't been true for the past, 10, 15 years. And so my question to you is, could it be different this time?
I think it's a great question, Stephen, and I do want to first off acknowledge that I'm well aware that, first of all, the small caps have been terrible for 15 years, almost everywhere, with the exception of Japan, and that value has been terrible, particularly in the U.S., although it's done fine internationally, which people are somewhat less aware of, that the sort of underperformance of value is largely a U.S. phenomenon. And I think that there are a few things to take away from that. I think one, um, uh, uh, as a historian, who was it that said, what happened? It was events. What happened is events, right? Events happen and they matter. People matter, right? What the history and the future are not some a gray series of mean reverting numbers. Rather, they're numbers that measure human achievement and human failure. And so we have to recognize that the numbers are a history. They're telling a history, and it's a history of people and their events. And so there has been something unique that's happened over the past 10 or 15 years that we have to understand in order to understand why value hasn't worked. And what's happened over the past 15 years is very simple, which is that there's been a massive technological innovation, a technological leap on the scale of the railroads or the invention of the internet, right, that we have lived through. And that evolution it's happened on the internet, and those technology companies that have been the drivers of this innovation of the cloud and SaaS software and mobile. The benefits of that have been accrued massively to the largest players, which is so unusual, right? Typically, you see small companies growing faster than large companies because it's easier to go from $1 billion in revenue to $2 billion in revenue than it is historically to go from 100 billion to 200 billion in revenue. But in the age of the internet, what it's turned out is that these firms that develop these winning scale edges, they can go from owning the entire U.S. market to owning the entire global market, and they keep scaling. And by the way, a lot of it's zero marginal cost, although that's changing with AI. And so what you've lived through is this tremendous innovation wave. And because of that, all the stock market profits, or the vast majority of the profits in the last few years, have accrued to a very small set of global technology leaders. And that's what's happened, right? And so you can say, well, why has value not worked? And you say, well, actually, it's not. Value's probably been fine. What's happened that's been abnormal is how wonderfully large growth has done. That's the historic anomaly, and it's an anomaly that's easily explainable. And the question now, as we sit here, is, will this continue? Right? Will this phenomenon of the largest U.S. technology companies continuing to grow at massive scale and massive profitability, and thus their stock prices to continue to drive the market years into the future, going to continue? And I think that, in my mind, I think there's the future nihilist view, which says, who knows, but probably not, right? Why would these 7 stocks magically produce higher earnings growth forever or higher returns forever than other 493 US stocks? It just doesn't seem totally plausible as a forecast. It seems like there's a lot of hubris in extrapolating that past. That extrapolating the past generally doesn't predict the future, so why would it for these stocks? And I think then there's a specific problem with these stocks, which is that they've, in the past year, gone from low capex, low marginal cost, highly scalable businesses to massively investing in a highly capital intensive, high marginal cost activity, which is AI, which I think people don't fully understand. These AI models are extremely costly to run. Each search on ChatGPT costs massively more than each Google search. And so I think their business model, at least they're trying to change their business model to one that looks to me to be significantly worse than their previous business model.
It's perfectly obvious, isn't it? I mean, they can't make the same returns from the AI investment they're making their core business. I mean, it's patently obvious, and yet the stock market is rewarding them for spending the money and creating deteriorating returns. Well, do you have any sort of theory about that?
I do, and I think that again, this is my historian lens. And I'm a fan of Robert Shiller, a big fan of Robert Shiller, and he has this book, Narrative Economics, and that narratives shape human events as well. Mimesis, and I think if you think about the lessons you've learned as an investor. The number one lesson you've probably learned over the past 10 years is don't bet against Silicon Valley. They come up with something crazy. They say, I'm going to produce electric cars. And you say, oh, they'll never make electric cars. And then they make the electric car. And then you say, well, they'll never make electric cars profitably. And then they make electric cars profitably. And then they say, we're going to make autonomously driving electric cars. And you say, no, they'll never do that. That spend is crazy. And then they do it. And that's been sort of the lesson that people have learned. And in fact, kind of the stupider, crazier that the idea that's come out of Silicon Valley has been, the better it's done, right? So if you say, well, there's no chance people are going to accept some digital currency that's created by, hackers in Kazakhstan, and trust that with their payments or their savings, that's just insane. You would have, missed out on all the gains of Bitcoin. And I think because that lesson has been so ingrained in people's heads, you come out and say, well, Google and Microsoft and Tesla, they all want to spend massively on AI. I don't think that spending is a good idea. And people say, well, who do you think's more likely to be right on this? The CEOs of Google, Microsoft, Tesla, et cetera, who have all been just on this complete winning streak, or the stupid cynic who's been skeptical of everything, and been wrong. On every major technological advance, which have all worked. Crypto's worked. Autonomous driving's worked. Electric cars have worked. Right? It's just sort of a litany of lessons, and I think that's the challenge we face today, Stephen. All the short sellers have gone out of business. All the skeptics have folded. And we're living in this age where an unbounded faith in the future of innovation has been the winning strategy. And I question whether that can continue. I think nothing continues forever. I think everything cycles. And so maybe I'm the oldest 38-year-old on the planet, writing that these timeless historical lessons will continue. But I think that they will, and I think any student of history realizes that there are trends and there are temporary narratives that pervade in markets. But you can't bet on them continuing forever. That's going to end in disaster.
Well, of course, the share price performance can't continue forever because they would be, such enormously valuable businesses, and although if you take the railroad analogy, in the 1870s, the railroads got up to, I think, three-quarters of the stock market. So, we think 30 something percent concentration is, bizarre and over the top. But I mean, we could double if we went back to the 19th century, which is, I think is an important thing to think about. But
Yeah, well, I have a personal story on that one, Stephen, which is my great uncle, who's sort of a mentor, has been a mentor of mine. He's an amazing guy, and his grandfather and his brother went into business together in the 1880s or 90s, and they bought a bunch of railroads and built railroads. They were big railroad tycoons, and then in 1908 there was the big railroad collapse, and he went bankrupt, and his brother went bankrupt. But at the time, my great uncle tells the story, and I haven't gone and fact checked this, I should, but my great uncle said that at the time, gentlemen didn't go bankrupt. So rather than go bankrupt, they kept the loans. And my great grandfather and his brother spent the first 20 years of their career paying off their father's loans. And then before finally sort of emerging out of it. And that's sort of where my great uncle's story comes in. And so I think, yes, of course, these concentrated bets can be fantastic and they can work for many, many years. Um, but the railroads still all went bankrupt, right? I mean, and look at what happened in the 90s. And so I think that as painful as it may be, and as boring as it may be to counsel things like diversification at a time when everyone calls it diversification, right? Of course it's diversification. Of course diversifying is always diversifying into things that have historically been lower returning. But the reason for doing that is so you don't put all of your eggs in one basket. And I think today, the S&P 500 is very concentrated, and it's very concentrated in a set of companies that are all taking the exact same bet, which is that AI is going to be this massively profitable innovation. And we don't know if it will.
well, I think we probably do know. Do you think the growth of passive has also contributed to this? Because it means that price discovery has gone out the window. And, David Einhorn was very eloquent on this. He talked about, oh, well, there's no point in finding cheap stocks because they don't go up because there's no value investors left looking for them. So his traditional model was to buy something whose earnings were going to be upgraded and then wait for a Fidelity or a Capital to go, oh, we think their earnings are going to be upgraded and push the price up. And he says that there's just no value investors left doing that work. So there's no point in doing it. I mean, have you thought about this at all?
Yeah. I think that the price discovery questions are very, very hard to answer. So I'll say on that I've tried to think of ways to sort of test that. And I approach everything, Stephen, with a skeptical lens. Let me try to test this. Let me run it through some empirical analysis, and that's why the book is full of my own empirical tests of various ideas, which is where I come to testing whether people's growth rates are accurate or not, or whether people can forecast things. I just have this intensive ability. You tell me something, and I go and test it, and most of the time it's not right. And so I'm skeptical of the price discovery argument because it's very hard to test, and I don't think he's tested it. But what I'll tell you is, I think, a very clearly testable hypothesis that is correct, which is that as you've shifted money from active to passive, that passive money has disproportionately gone into strategies that are benchmarked to two indices, and those two indices are the S&P 500 and the total market index, the U.S. total market index. So when people shift to passive, they've tended not to shift to, say, the FTSE Developed ex-US Index or the Vanguard, or the US Mid Cap Index. Passive for them means the most common, most salient passive indices, which are the S&P 500 and the total market. So there's been a mix shift in investor allocations towards the S&P 500 at a time when the S&P 500 has outperformed virtually everything else, right? It's very hard to find an index that has outperformed the S&P 500 over the last 10 or 15 years. It's nearly impossible. And the fact that it's the biggest index makes it all the more compelling to shift towards passive by shifting to the S&P. And I think that's where, I have a beef with passive, because I think if passive means, own the market cap weighted benchmark and own it at zero fees, well, gee, that's great. But if it means massively overweight the largest U.S. Equities rather than considering anything else, I think it's a mistake. And I think the simplest way you see this is U.S. versus international, where there's a huge premium to being listed in the U.S., which has nothing to do with fundamentals. It's entirely driven by just having a U.S. listed ticker. And so investors are just massively shifting their allocations into the United States, 80% US, 90% US, 85% US. And so why do I need international stocks? And I think that these errors are being driven in part by the shift to passive. And I think that that's a more obvious thing that I think you can definitely prove. Whether it's impacted price discovery, I don't know necessarily how to prove that on an individual stock basis.
No, well, I mean, I don't know if David's tested it other than his own personal. Well, he's tested it. I mean, yes, he's tested
He's
it
lived
because
it. As
what he
have I.
was doing isn't working anymore. So,
Yeah.
and he's modified his approach. And listen, I mean, he's a really, really smart guy, and he's thought about this very, very carefully and very deeply. But there's a related point in this, and there's a great table in the book, and you look at the persistence of growth among firms starting in the top quartile, looking at revenue. Revenue is quite persistent. Profitability is not quite as persistent. And you say that profitability is actually less persistent than chance. And I thought it was a brilliant table. So can you explain your conclusions and then explain, well, why is anybody a growth investor?
Yeah. So basically, what we find again is that historical revenue growth or earnings growth does not predict future earnings growth or revenue growth. And this is really hard to believe because it seems so intuitive that it should. And so we've broken it out in a whole number of different ways, right? One of the ways we look at it is we say, take companies that have grown in the top half. What's their chance of growing in the top half again next year? Or we say, what about top quartile growers? What's their probability of being in the top half of growers next year? And then what if you compound that? Say, what if they've grown revenues fast, their top quartile over the last 2 years, the last 3 years? Does that predict their next 2 or 3 year compounded growth? And what you find in every case is that the historic growth does not predict future growth. In fact, it's worse than a coin flip. So the coin flip is the better analog, right? And remember, this is a very crude estimate. We're not saying 9% predicts 9%. We're saying, hey, top quartile predicts being in the top half, and that's a coin flip. And if you compound it, it's a coin flip times a coin flip times a coin flip. And so I think this is sort of the striking finding of this work, is that relying on historical growth rates or historical financials to predict future financials doesn't work.
But if we had Chris Mayer in the room, the author of 100 Baggers, he would say, well, actually, that's quite wrong because, the companies in my portfolio have grown consistently year after year after year. And I'm kind of, I don't disbelieve you've done the research and this is the findings, but I find it hard to square with my perception that, there are some high quality companies out there that grow consistently over time. So, why is it that Coca-Cola has been a consistently strongly growing company over decades, yet your results suggest that if I look at a Coca-Cola, it's highly unlikely that that will happen.
Yeah, I think that I think there are a few things to note there. I think one is that again, I can't say anything about skill. So it's possible that there's 1% or 5% or 10% of people that can reliably pick these companies that grow sustainably over time. And I don't have a way to sort of prove that that's true or not true. Um, uh, but I think if you separate the question of like, well, is it true? Can I subsegment any type of company, right? So let's take this technology companies, or let's right. Almost any one of those things ends up not meaningfully predicting future growth in any reliable way. And I think the problem is always you've got to take the full picture, right? You can't just take Coca-Cola. You got to take all the companies like Coca-Cola. And it turns out that when you take them all as a group, rather than focusing on one specific example, you see the unpredictability of growth over 1, 3, 5-year horizons. Now, I'll get to another point, Stephen, which is I think sort of where you're going. Um, what is persistent or predictable? And Coca-Cola is a great example of this. What is persistent or predictable? And this is where I have more sympathy towards what some on the Twitter call the compounder bros than I do for the quote unquote growth or GARP investors, because I think that there is a persistence to return on assets. So what you do see is that if you take every company and you rank them, my preferred metric is gross profit divided by assets, but it's basically an ROI metric. What you'll see is that today's ROI, as measured by GP to A, predicts 5 years or even 10 years from now's gross profit to assets. So that companies do have sort of a persistent characteristic of return on assets. And if you look at those companies that have very high return on assets, like Coca-Cola, they do persist in having high return on assets. And as a result, those companies end up being safer. They tend to be more likely to have persistent long-term growth. It doesn't mean that over any 3-year or 5-year period, they're necessarily going to grow faster than the market, but simply that their sort of stability over the long term is much more likely, that they're better businesses in almost every sense of the word than the lower return on asset businesses. And so I think that where I sort of separate it out is, from a quantitative investor perspective, right? There are sort of two polarities, right? Which is you either want to buy value, where people are basically they're wrong in being excessively pessimistic about a set of companies, and you're saying, gee, the future is hard to predict. I know you think that every oil and gas company is going to go out of business because of climate change, but what if they didn't? I mean, it's that sort of like, but what if? That's sort of the value investor mantra. I know you think that, but what if it didn't come true? What would happen? What if coal didn't go to zero? Then what would happen? And so that's sort of the value investor type stocks. And then there's the quality, what I call the quality type of stocks, which are the really high return on asset businesses. And by the way, those do really well over time too, as Coca-Cola is an example of it's a persistently high return on asset business. And those things are not correlated.
But it might not be good to buy it today because you might end up paying too much for it. So, no, I completely get that. But why do you choose gross profit to assets? Why do you choose that metric?
Yeah, so this is always a tension between quantitative and fundamental investors, which are fundamental investors will say, well, that's a lousy metric. It doesn't tell us anything about a company in particular. And I'll say, yes, it might not tell you anything in a company in particular, but if you compare companies across a broad range, right, you're trying to sort 3,000 companies, it's the best metric because it's crude. And when you get into, say, return on investments, net income is way too volatile. Which is one of the reasons it's not persistent. But gross profit is pretty stable, actually. It's closer to revenue in terms of its stability. It's much less volatile than net income, right? The further down the income statement you go, the more volatile the series is. So you're trying to find a less volatile series. Gross profit is less volatile, and then divide it by a balance sheet metric, in this case, total assets. And what you find is it does a great job of comparing across firms. And if you just scan within any industry and you say, hey, show me the ranking, you're not going to be surprised by what companies are on the top. It's very intuitive. And so I think it's a beautiful metric because of that. It's just great at ranking and sorting. Even when it comes to analyzing an individual company, you'd say, well, it doesn't take into account this or it doesn't take into account that, all of which is true. But that's not its main function. Its main function is comparison.
And you have found it to be a more persistent measure than other measures, partly because of volatility lower down.
Exactly. The lower down the income statement, net income is way too volatile. And so, ROI is far less persistent than gross profit to assets, right? Because what we want is a reliable way of sorting 1,000 companies that if I looked at the same 1,000 companies 5 years from now, there'd be a very high correlation between this sort and that sort. And that's what gross profit to assets is good at. Whereas ROI is not good at that, because you have companies that have 1 year, they have some special loss, or there's a out of the cycle, right? It adjusts for all of those things.
No, sure. It makes perfect sense. I mean, gross profitability is one of the things that, when, I've got these online courses, and we spend quite a lot of time sort of trying to help people understand business quality, and we look at gross profitability in some detail. Now, we've both been writing about private equity, and I've been really enjoying your blogs on the subject, and I know that I'm needling a bunch of people in the private equity industry, because when I write about it, I get, the incoming mail in response is always, well, you don't know what you're talking about. I'm in private equity, and I just don't get what people find so difficult about this, because it's blindingly obvious, isn't it, that the opportunity set today isn't what it was 20 years ago. We've had declining interest rates and rising valuations, and that's all stopped. May or may not be going into reverse. And the higher starting valuations have got to be a barrier to returns. And the sheer weight of money invested in private equity funds today, relative to where it was 20 years ago, inevitably must lead to lower returns. That's not, leaving aside the fact that debt will cost you more, so your leverage will have to be lower. Why don't allocators understand this? I mean, it's so obvious. I get so much pushback. Do you get pushback on your stuff?
Yeah, it's remarkable, Stephen. I mean, I think you look at even basic arguments that you can make about private equity, right? So you'd say, well, gee, private equity companies are a lot smaller than publicly listed companies, and smaller companies are more risky than bigger companies, and they borrow a lot more money, and companies that borrow money are more risky than companies that don't borrow money. And third, most private equity funds own concentrated portfolios of 10 to 20 securities. And owning a concentrated portfolio of 10 to 20 securities is far more risky than owning a diversified portfolio of 500 or 1,000 securities. So therefore, private equity should be much, much more risky than owning the public stock market. And you'll get so much pushback on even that, right? People say, oh, no, that can't be true. My private equity firms are not volatile at all. It's not risky at all. I've never lost money in a private equity fund, right? Or something like that. And I think that people just don't realize the risk, right? So that's sort of step one. And the reason they don't realize the risks, even, I think this is sort of an important thing to understand, right? Is that private equity, the sort of target universe of private equity, is tiny. It's tiny. So they'll always, in the marketing materials, they'll say, well, there are 1 million private companies and only 10,000 public companies, and so the opportunity set for private equity is massively bigger. But how many dry cleaners does it take to add up to a Facebook? Right? I mean, so who cares if there are 10,000 dry cleaners, right? I mean, I don't care, right? Like, add up all their profits, you're not even going to get close to Facebook, right? So what matters is the profit pool. And the profit pool, the accessible profit pool of these private companies, is probably 2 to 4% the size of the S&P 500 or the public market, right? It's tiny because they're microcaps. They're tiny little microcaps, and microcaps have thin profit margins anyway. And so you're basically saying, and then you're seeing institutional allocators put 40% now of their portfolios into a target universe that's 2 to 4% the size of the public equity market universe, right? And they've gotten there over time by increasing their allocations. And what you see in an illiquid asset class, right, something that's illiquid and small, is that fund flows matter a lot more. And so as funds have flowed into the asset class, they've buoyed valuations, they've increased competition, they've made it easier to sell, right? If there are 5 private equity companies this year and 10 private equity firms next year, your ability to sell the companies in your portfolio has become easier by the fact that there are 5 new entrants who all need to deploy funds, and they'll be happy to buy your company from your portfolio. And so I think that sort of rising tide of new money flowing in has lifted all boats, but it's lifted all boats by pushing valuations up. And now you've also seen the rise of private credit, which is promising equity market plus returns. And those firms are doing that by lending to these private equity deals. And so I think that this whole thing has, yes, the returns have been good. And I'd say there's been sort of two eras, maybe three eras. There was sort of the pre-2008 era, call it 1985 to 2006, where the returns were fantastic. Okay, like you just look at those returns, it's just unbelievably good. You're talking about beating the public market by 400 to 600 basis points a year, 4 to 6% per year, on top of the, that's after the fees, which were insane, right? And then I'd say there's the period from sort of the financial crisis to the present, where private equity has kept up with the S&P 500, which is remarkable because small caps have done so much worse than the S&P 500. So, but they've kept up with the S&P 500. And I'd argue that's the period where the economics were deteriorating, but the fund inflows were magnifying. And so, you had great economics with limited fund flows for the first 20 years. Then you saw deteriorating economics with increasing fund flows for the last. And now we're in this period right now where the fundamentals are deteriorating and the fund flows are deteriorating. And what you've seen as a result is that hold periods are getting longer and longer. The private equity firms can't sell their businesses. And as a result, the trailing returns for the first time, if you go look at endowments and foundations, the last 2 or 3 years, the ones with lower private allocations have done better. Now, if that continues, you're going to see even worse fund flows, and because these things are recursive in a way, fund flows can drive outcomes, just like outcomes drive fund flows. I think that's we're in the beginning of the first 2 years of what I think will be a very, very challenging period for the asset class.
Yeah, well, I mean, it's almost impossible for it not to be, but what I'm puzzled about is why this isn't clear to the vast majority of people. And I get enormous amount of pushback on it. Now you get all sorts of comments about, well, these private equity people, they're brilliant at operations. And you studied nearly 1,000 PE deals over 25 years where there was public data available because there were debt securities. And you concluded that private equity doesn't add value operationally, which is actually very consistent with the commentary from Bain Capital, which says that there's the tiny. What can you just describe what you did in those conclusions?
So what I did is I looked at the subset of private equity deals where public debt was issued at the time of the buyout. So now you can talk about this being some skewed sample in some way, and let's just assume, for the sake of argument, that it is a skewed sample in some way, right? It's not perfect, but if operational improvement is an explainer of private equity returns writ large, then we should see it even in a skewed data set, right? Like we should see, okay, like here it is, the operational improvement, right? I mean, it should show up, right? Otherwise, it can't drive returns in aggregate, right? If it's not showing up in a sample of 1,000, especially these 1,000 larger deals, which are probably a disproportionate weight in the overall, right? It probably doesn't show up at all, right? We should see hints of it. We should, right? We should see the leaves move as the wind blows through the forest. And so we looked at, the 3 years prior to the deal and the 3 years after the deal. What happens to revenue growth, EBITDA growth? We both do it on a compared to their sector. So you say, this is a telecom company. How did its revenue growth compare to the telecom sector prior to acquisition and post acquisition? We also do it not doing it that way, just on a raw basis. And what you see is that that revenue growth maybe slows a little bit, right? Which sort of would coincide with your view that active managers are buying companies that have a higher revenue growth because they think that's going to continue, and then chance happens, and then they grow normally. So you sort of see that slowing down of revenue growth. You see that margins don't change all that much, which is sort of surprising, right? The sort of cost cutting doesn't actually end up happening all that much, right? At least it's not evident in our data set. CapEx goes down a bit, which sort of, goes through probably they're cutting bad spending. But what you do see systematically, huge change, right? Huge. And you see it in almost every deal, is a massive increase in debt, which sort of makes sense, right? This is the leveraged buyout industry, and they're issuing public debt as part of the buyout. So of course, right, debt is going up, and so is interest payments. And so what you see is that, and I think this sort of should jive with our intuition, right? Who works in private equity, Stephen? It's a bunch of former investment bankers, right? When did investment bankers magically learn to run industrial companies or consumers companies, right? Like, where do they all become
They're all
bell bells?
geniuses, all the investment
Their
bankers.
operational genius, right? Is that really plausible, or is it more plausible that what they're really doing and what they're good at doing is balance sheet engineering, right? Of course, it's what they're doing. That's what they do in every deal, right? Do they make an operational improvement in every company they bought ever? No, but do they had debt in every case? Yes. And so I think that's the operational change that's happening, and I think that that's where what I think people miss about private equity. It's a balance sheet game, and it's not an income statement game.
I love the quote from Bob Maynard, who was the CIO of the Public Employee Retirement System of Idaho. He said, "It may be phony happiness, but we just want to think we're happy. If private equity just gave public market returns, we'd be in favor of it because it has some smoothing effects on both reported and actual risks." And what do you make of that statement? I mean,
I love it. I mean, I think you see exactly what's happening, right? Like, who wouldn't want it, right? If the market goes down 20 and private equity goes down 10, and you can say you beat the market by some massive amount because you made the genius decision to put half your money in privates, that's sort of what's happening, right? Everybody loves it. There's no one who dislikes it. It's, as Cliff Asness calls it, it's volatility laundering. Who likes volatility?
yeah, well, that's right. Now, we won't talk too much about private credit because it's pretty obvious that they're just lending the money to the private equity companies. So, I mean, I think what they've been very clever about, the private equity firms, is kicking the can down the road and not bankrupting the businesses, with very rare exceptions, and lending them PIK notes and other funny instruments. The asset class is still growing like a weed. So nobody's reading your stuff or my stuff because, and good luck to them. And you've got a great table in the book on declines from peak search interest in Google Trends. So the .com theme, peak search interest, was February 2000, and the 12-month forward returns were minus 90%. And you've got a whole list of these going through. Well, where did you get that idea from? Oh, it's very clever.
Yeah, well, I was interested in sort of this narrative, how much do narratives matter? And so, I wanted to go out and test it. And indeed, you see that when people get too interested in a narrative, when it becomes too popular, the returns end up looking terrible thereafter, right? It's sort of obviously intuitive, right? That stuff that gets people get too excited about overshoots. And I think that's particularly been true in the sort of meme stock era.
How would you think about testing when the peak arrives? How would you know?
That's a much harder question, Stephen. I don't think you can. It's really hard. And I have a whole thing in the book about predicting bubbles. And one of the things I observe is that smart people always identify bubbles too early. It's just the nature of things, right? Because overvaluation and bubbles, they always get, worse and worse and worse. And the first hints of irrationality strike the smartest people first, and then the bubbles tend to continue for years longer. And it's sort of a fool's errand to try to call the peak of the bubble or even know when you're in a bubble. But I think that one can just try to take prudent action consistently over time, and it does pay off, right? These bubbles do burst, and they burst so suddenly that years of excess returns can get lit on fire in a year. Or a 6-month period, and all of a sudden the trailing returns, the people that were sensible and stayed out of the bubble, look better than the people that a year before were looking like complete geniuses and market beaters, whose profits just get lit up on fire, because so much of it is dependent on rising valuations, rising forecasts of the future, which drive those valuations, as opposed to actual cash flows and actual earnings.
Yeah, I mean, I think there are occasionally, people ringing the bell. So, the likes of Julian Robertson giving up because he just couldn't make money buying proper companies and shorting tech fads. And I don't know if it was to the day that he closed Tiger and the market top, but the two things weren't far away. And I think Jim Chanos closing his business, his short selling oriented fund, probably was close to the bottom in terms of, creating real opportunity for short sellers. And before we go, do you want to just say a little bit about Verdad Advisors and what you do and how you do it? And just explain to people how you came to this role.
Yeah. Well, thank you, Stephen. I mean, I think that my big focus has been exactly what we've talked about, which is trying to study history, to derive the lessons from it, and then to turn that into investment strategies. And I think also I've grown up in a world where passive was huge, where I understood that you don't want to necessarily compete with passive. And so rather than say focusing on trying to develop another firm that manages large cap US equities or something, I've been very focused on niches, on small areas of the market where I think there are mispricings or where things are less efficient. So we do a lot of work in micro caps, sub 400 million market cap stuff that index funds can't even touch because they're too illiquid. And our view is that that might be a place where there's more inefficiency to be had, and at very least where we're providing exposure to something people can't get elsewhere. And so that's really what we built. We manage about $1.1 billion across a few different strategies. And all of the core research behind our strategies is described in this book, around how we think about equities and value, how we think about credit, how we think about market timing, and cross-asset investing. And all those different areas, I think, are places where we spend years studying, long-term histories, long-term returns, and then trying to develop theses and testing them over historic data, and then trying to apply them in real time. And so I'd say the great benefit of that is it's very intellectually consistent. It makes sense. And the negative of it, I think, is that I probably have been too skeptical of the current bubble. What I would call the bubble. We haven't owned NVIDIA or anything like that for both because it hasn't fit within the mandates of any of our niche strategies, but also because of my skepticism about things that have very high valuations. And I think that that's sort of the fundamental issue that I think all investors are facing today, which is that the best performing thing is U.S. large caps, and that's also the most expensive thing. And those things have been true for the last 2 or 3 years. And so, how much do people want to risk on that, and how much do they want to diversify? And I think it's a really hard problem that people are really wrestling with.
And you've grown the business really on the back of your writing. Is that's my understanding?
Yes.
And that you couldn't have done that 10 years ago or 15 years ago.
No, it's the amazing thing about the internet. You can share your ideas to the huge audience very easily. And I think the internet is very merit-based, right? If your writing is good and people like your ideas, people will pay attention. It's the same with podcasts, right? I mean, I think it's a wonderful development, for the Davids as opposed to the Goliaths, right? The intermediaries aren't trusted anymore. People want to go out and find authentic voices of people that are doing interesting things or saying interesting things, and it doesn't matter whether you have some big bank research arm behind you or not.
No, and I mean, I think I don't know anybody else like you who's done that way. And so I was very interested in that. Where do you see yourself going? I mean, do you think this just carries on because as you write more people share it and more people find you and say, he sounds quite sensible, let's give him some money? I mean, is that how it works?
I hope so. Although, my real hope, Stephen, is that I uncover some secret money-making formula, hopefully in the next 12 months. And then I'll go completely silent. So if you don't hear from me, I've either gone out of business or I've discovered the magical elixir to making money, which I'm hiding from everyone else. But hopefully it'll continue in that pleasant middle ground where I keep sharing, and hopefully the firm keeps growing.
Well, people can read your blog and buy your book, which is definitely worthwhile. Where can people find you, Dan?
I'm on Twitter at VerdadCap, or X, sorry, at VerdadCap. And my website is www.verdadcap.com. And you can buy The Humble Investor anywhere books are sold.
Well, we'll definitely link to that in the show notes. Dan, thanks so much.
Thank you, Stephen. I very much appreciate it.
I told you that Dan and I didn't entirely agree, but this was largely a function of looking at factors through different lenses. Dan is interested in base rates, and I'm interested in specifics. And of course, both viewpoints are valuable, but for different applications. Which is one reason I enjoy doing this podcast so much, because I get to learn about markets from different perspectives. If you enjoyed the conversation, I highly recommend Dan's book, The Humble Investor. And if you buy it via the show notes, there's an affiliate fee which is donated to Duchenne UK, our supported charity. You can find it at my website, behindthebalancesheet.com. Thanks as ever for listening. Don't forget to subscribe and please tell your friends about the show. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel. And why not visit our website, behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.